The cash flow statement tells us whether the business has enough liquidity to survive.
To make it simple, the cash flow statement is divided into three main sections. We have the operating activities, investing activities, and the financing activities.
Let's break each section down, starting with the Hello, welcome to the Nigerian Investors Podcast, the unofficial podcast that tracks and reports on the activities of the Nigerian boss. My name is Mudi, and with my colleague Aye, we will be hosting this podcast. TNI Podcast is dedicated to stimulating a renewed enthusiasm among the general population with regard to the activities of the Nigerian Stock Exchange. Ultimately, the goal of TNI is to see that many Nigerians from all walks of life, both at home and in the diasporas, become active participants on the floor of the Nigerian Stock Exchange. Before we go further, we would like to place on record TNI podcast is solely for educational purposes and not a replacement for professional financial advice. Let's begin. Welcome to the Nigerian Investor, the podcast that simplifies investing and finance for everyday Nigerians. I'm your host, Mudi.
And I'm Aye, and on today's episode, we're diving into another key financial statement that every investor and business owner must understand, and that is the cash flow statement.
If the income statement tells us whether a business is making a profit, the cash flow statement tells us whether the business actually has money in its hands. And trust me, a business can be profitable on paper but still struggle with cash flow.
That's right. A company can report huge profits but still go bankrupt if it runs out of cash to pay its bills. That's why understanding the cash flow is critical for investors, entrepreneurs, and even individuals managing personal finances.
By the end of this episode, you will understand what a cash flow statement is, the three main types of cash flow, and how to use it to analyze a company's financial health.
Let's get into it.
All right, let's break it down simply. The cash flow statement is a financial report that tracks how cash moves in and out of a business over a specific period of time. It could be monthly, it could be quarterly, or it could be yearly.
And interestingly enough, it's different from the income statement because it focuses on actual cash movements, not just revenues and expenses. One very interesting thing about accounting that I think we should just point out quickly is that the income statement uses accrued accounting, which basically records business transactions as they happen, even if cash hasn't really changed hands. Whereas the cash flow statement focuses on the real cash transactions happening in the company. So think of it like tracking the money in your bank account. What came in, what went out, and what is left.
That's true. A company might report high revenues, but if most of that money is stuck in unpaid invoices or used to buy inventory, it may not have enough cash to pay salaries or debts. That is where the cash flow statement comes in. It tells us whether the business has enough liquidity to survive.
And to make it simple, the cash flow statement is divided into three main sections. We have the operating activities, which is basically the cash from the company's core business operations. We have investing activities, which is cash spent or even earned on investment or from investments that the company makes. And then we have financing activities, which is cash from borrowings, issued shares, or repaying debts. And this can also include dividend payments.
Let's break each section down, starting with the cash flow from operating activities.
Now, like we said before, this is the cash a company generates from its day to day business operations, selling products, paying suppliers, and handling expenses.
Yeah, I want you to really give more emphasis to this because I want our listeners to really differentiate between cash flow from operating activities and flow from investing activity. Let's use a bank for instance. When you are referring to cash flow from operating activities, how would you describe it using a bank?
So, for our listeners to truly understand the distinction between cash flow from operating activities and cash flow from investing activities, for a bank, for example, the core business activity of a bank is to give out loans and to take interest payments from those loans. They also invest in investment securities such as treasury bills, bonds, and they also engage in other financial activities that they provide for their customers, which they take fee and commission income from. Now, all of that is their core business operations, and the cash flow that they generate from these core business operations is what will appear on the cash flow from operating activities. However, when we talk about investing cash flow, we're talking about all the cash that the company either invests in itself or generates from investment that it has made. For example, when the company invests in property, plant, and equipment, that's considered as an investing cash flow. Also, when the company invests in subsidiary companies, right? For example, let's say GT Bank decides to acquire a fintech company, that is considered an investment, so it's an investing cash flow. So it will not appear in the operations because it's not part of the core operations, but it's an investment the company is making in itself or in another company, and it will appear under the cash flow for investing activities.
Thank you so much for that, Aye. Just to highlight more about this cash flow from core operating activity, it includes things like cash received from customers and cash paid for rent, salaries, and utilities. If this section shows a negative cash flow, it means the company is spending more than it is earning from its core business.
So next, we have cash flow from investing activities, which includes money spent buying or selling assets like land, building, equipment, or even investments in other companies, as we explained.
A negative cash flow here isn't always bad. It might mean that the company is investing in future growth. But if a company is selling off assets to stay afloat, that is a big red flag.
Finally, we have cash flow from financing activities, which includes cash received from loans, issuing shares, or repaying debts.
This section shows how the company funds its operations. If a business is constantly borrowing to survive, it could be risky. But if it is raising money to expand, that might be a good sign.
Now, let's talk about why this matters to investors like you.
A company can report profit but still collapse due to poor cash flow. If a business can't pay its bills, it doesn't matter how profitable it looks on paper, it is in trouble.
A strong cash flow means a company can invest in growth, pay dividends, or handle unexpected expenses.
Okay,
So it's a sign of a financially healthy business.
that's true. Moving on, here's a quick formula to remember. Net cash flow is equal to cash from operating activities plus cash from investing activities plus cash from financing activities. If this number is positive, the company is generating more cash than it is spending. If it is negative, it might be struggling.
So there you have it, the cash flow statement decoded. One quick thing I think we should point out to our listeners is this. When interpreting the cash flow statement, it's important to understand the context with which each of these three sections is presenting the company. When we look at the operating cash flow, we're looking at, okay, how much cash, positive cash, has the company generated from its core operating activities? What we like to see here is a positive. However, from time to time, the company might have a negative cash flow from operating activities. This is not necessarily a bad sign, as companies will have to manage their cash flow positions, and at times that might lead to a negative. However, on average, we like to see positive, growing operating cash flow, and then we like to see that it can use this positive cash flow from operations to then finance its investment in itself. So what we like to see in the cash flow from investing activities is that the company is not just investing in itself, but the cash flow from operations can finance those investments. Now, this is not always going to be feasible, so sometimes the company might need to make more investment in itself than the cash flow from operations can provide. That is then when we look at the cash flow from financing activities, which helps us to track where the company is getting additional funding from to invest in its growth, and if the company is also being able to pay dividends to shareholders. So it's important to understand how these three different cash flow statements present the company and track it to see just what the company is doing in generating cash, investing that cash, and what it's also doing to finance its growth.
Thank you so much for that, Aye. Understanding cash flow is key to making smart investments and business decisions. Always check it before investing in any company.
Now, if you found this episode to be helpful, Don't forget to subscribe, leave a review, and share it with someone who needs to hear this.
For more financial insights, follow the Nigerian Investor on social media. Let's keep this conversation going.
Until next time, stay informed, stay empowered, and keep investing wisely.
Thank you for listening to another episode of the favorite podcast that brings insight to the Nigerian stock market. We hope you enjoyed today's episode. To get more episodes like this, follow us on YouTube, Twitter, Facebook, Instagram, TikTok, Amazon Music, Apple Podcasts, Spotify Podcasts, as well as on our website. All this information is available in the show note below this episode. Until we bring you another episode your way next week. Bye for now. Mudi and Aye podcast is executive produced by Mudi. This episode was edited by Rona at Rockwari Village Studio.